It's all about money. At the HouseStreet.com Money Expo, see Danielle Park, video by Doug Casey, Ross Clark, Maren Katusa, and David Smith. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca.
Welcome to the Money and Wealth Show, brought to you this week by American Manganese Incorporated. Here's your host, Sterling Fox.
Welcome to the Money and Wealth Show, the program that offers opinions on business, the economy, and the markets every week. And this week, we have a special guest who has a lot of opinions about personal finances. It's a real pleasure to welcome the president of KCM Wealth Management, portfolio manager and investment advisor, Adrian Mastracci, to the program. Hi, welcome.
Thank you for inviting me.
Now, it's good to have you with us, and we are right in the middle of retirement season. The RRSP has to be done by what date?
March 1, 2011.
Okay, so the big push is on for the retirement crowd, or the people who want to get their retirement somewhat organized, to get it done by March 1st. But this year, as has been the case for the last couple, there's a new player on the field, so to speak, that seems to be attracting an awful lot of interest on the part of Canadians, Adrian, and that's the TFSA, the tax-free savings account. What are the basic differences between the RRSP and the new TFSA?
Well, essentially, the TFSA is one where you put tax-paid money in there already. So you take some of your cash, put it in, nothing gets deducted. But what happens is the income you earn on that money, whether it's interest, capital gain, dividends, whatever, is then not taxed when it comes out of the TFSA. Conversely, on the RRSP, let's say you put in the same amount of money into it, that is a deduction from your income tax. And when that money comes out along with its income that you may have earned over the years, that is taxable as income when it comes out.
So the big deal, the big difference up front is the fact that one, you get to defer taxable income, and the other, you got to pay the tax on it, and then you get to deposit it into an account that ultimately has a lot greater tax benefits for you.
Exactly. That's essentially the difference between the two plans.
As I understand it, though, the big mistake that a lot of Canadians are making with the tax-free savings account is that they're treating it like a savings account. Whereas investment advisors, professionals like yourself, are saying, look, no, this is something that you can grow tax-free. So get at it a little more aggressively than earning very, very minimal bank interest.
Well, I think if your game plan calls for things like that, then the question becomes, where do you put the stocks? Where do you put the equities? Where do you put the mutual funds and things like that? Do you put them in the TFSA or RSP style of account, or do you put it into your personal cash account or corporate account? These are the things you have to look at when you've got those two in your game plan.
We have these two major options, the RSP, the TFSA. Is one or the other better suited for particular groups of Canadians, or is it just pick one and off you go, or play them both if you can?
Well, if you have the cash, playing both of them would be a good idea.
Okay.
However, in most cases, there's only so much money to go around. Chances are that the TFSA is probably the better one to start with in the younger days, and then you sort of graduate along to the RRSP maybe in your 30s or 40s when it makes more sense to put something away and deduct it from your income tax. I think those are the two things that you have to look at. And essentially, at the beginning, you might say to yourself, this will become my emergency fund. So if that's an emergency fund, then it's not going to be as playful, as aggressive as you might like. You might have the GICs. You might have the savings account in that TFSA.
Because you want it close by in case there's a problem.
Exactly.
Okay.
So you don't want anything that's too terribly exotic. You just need to get your hands on it.
So can you still put investments, though, that are some investments, some vehicles are more liquid than others? You can get at the cash conversion faster than others. If you're good at doing homework and you want to put something that will grow tax-free in that TFSA, then it's smart at least to put investment vehicles that can be liquefied or liquidated quickly in that plan that could be your emergency fund in addition to being a savings account.
Well, that's right. I think you can look at it that way. And the same investments that qualify for RSPs also qualify for the TFSAs, so you don't have to change horses between one and the other. But if you want something liquid, something conservative, then the GIC, the savings accounts, treasury bills, that sort of stuff, that's not going to return a whole lot these days. But at least you can get your hands on it.
Saw an interesting thing in the paper the other day. Again this year, as we're all putting the paperwork together for our RSPs, fewer than 40% of all eligible Canadians are actually going to put any money into an RRSP for the 2010 year, which we're still working on. Why is that? Is the new plan, the new tax-free savings account, the new kid on the block distracting or funneling a lot of money away? Or is there just less money available to Canadians to put into any kind of savings or retirement plan?
Well, I think you have a number of things. You've got the paycheck being stretched in a number of ways. The TFSA is the new kid on the block, and therefore it is taking some of the money from the RRSP. I think a lot of people are used to bigger mortgages right now. Maybe they've borrowed more money on their house or something like that, so they're having to pay more on that. Mm-hmm. Maybe they're raising children, and as you know, that's sort of it's an expensive way to go.
It is definitely
so,
expensive.
All of these things sort of come in, and essentially there's less money to go around, and if there's less money to go around, then you have to make choices.
But it's typical that fewer than half of us in any given year invest in an RRSP, and we'll pursue that a little bit after we take this break. Our guest is Adrian Mastracci. This is the Money and Wealth Show, and we'll be right back.
Always consult your investment professional before making any investment decision.
American Manganese Inc. has a world-class deposit in Arizona, indicated 6.7 billion pounds, inferred 8.9 billion pounds, potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at TalkDigitalNetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our guest this week is Portfolio Manager Adrian Mastracci, and we're talking retirement. And Adrian, we talked about tax-free savings account and the RRSP that is better known to us all. But I don't think anyone just rushes into a retirement or any kind of savings plan without a game plan of some kind going on first. What do you tell your clients, people who come to you saying, okay, I'm going to retire soon, I need to be organized?
Well, I think one of the key things to start at is, what is it that you're trying to do? Where are you going with this plan? What sort of income do you want down the road? When do you want it? Is it you and your spouse? Is it just you? These are the sort of things you start with, because what happens is that determines what size capital you need, what sort of return you need to get to where you want to be, and that's essentially where the game plan ought to start. Most people don't do that, unfortunately. But if you can't start there, it is a lot easier to do that.
So that means you should have some kind of a rough estimate as to what kind of annual income you would like to be able to live on after your retirement begins. Is that right?
Yes. You should have some idea where you're going with it, what sort of an income you need, what's probably okay for you and your spouse, and then ask yourself, what if I live to age 90? You know, what if I have a long life? Are there any people in my family that have lived a long time? My parents, my uncles, my aunts, you know, people like that. And if so, should I plan to age 90, 95, and ask myself, do I have enough money? Or how much money do I have to in order to get there? These are the sort of questions that you need to do, you need to look into before you say, I'm going to invest in whatever suits you.
Okay, suppose you come to the game, better late than never in terms of trying to get yourself organized, and you realize, look, there's just no way at this point in my life I'm ever going to be able to amass the amount of money in a big lump sum that will pay me $50,000 a year or whatever the magic number is for my family. How do you go about at least getting close to that?
One of the things you probably should have done is a retirement projection. Ask yourself those questions, how much you want and so on, and then ask yourself, what do I have to do to get from where I am today to where I want to be? Does it take $500 a month? Does it take $1,000 a month? You know, these are the sort of questions you have to ask, because if you know what it is you have to do, then hopefully you can plan for that, put it aside, sock it away, and over a period of time, give yourself 10 or 15 years before you actually have to retire to put away the big sum, you know, the bigger part of your total game plan. I think that's the better way to do it.
A lot of people, of course, recognize that there are government funds. There's the old age pension and the Canada Pension Plan that we all contribute to. But a lot of other people have pension plans of some description, usually with a company in one form or another. What percentage of Canadians have some kind of pension arrangement in addition to whatever their private TFSA or RRSP solutions they may be looking for?
It used to be higher and it's now getting lesser. But I think if we have half of the Canadians getting a pension plan, that's probably a little optimistic. And it's going less every day.
So with that in mind, then it really becomes imperative that you accept responsibility for your future, given the fact that whatever subsidies the government's going to offer isn't going to be much, regardless of how long you last, is it?
Well, it can be. For example, the Canada Pension Plan and Old Age Security, if you get the maximum under both, you will get roughly $18,000 a year, which is not bad. So if you've got two spouses, and if you can each get that, that's not that bad after all. So let's say you get 75% of you know, each one of your entitlements. You know, that's a reasonable area to start with, and then you have to make up the difference between that and what it is that you want to have. And maybe you've got a pension plan that'll kick in. Maybe there's some other things such as your RRSP and your TFSA. So just get a handle on what it is that your other stuff has to do in order to get to your goals, whatever they may happen to be.
Okay, now, I'm sorry, but I need to know about the formula, because you've identified the fact that you need to have an understanding as to how much money you think you're going to need and some way of getting that money organized while you're still able to do so. What's the math involved? Is there a secret formula or perhaps a well-known formula that people can use to get that number fixed in their minds?
There are many formulas. The one that I like to use is not so much a formula. I say to my clients who are thinking of retirement, if this was your year before retirement, what are the expenses that you incur? Because the expenses that you incur after retirement are much the same. You can always you know, chat about the allocation between one thing or another, but the bottom line of expenses will be roughly the same both before and after retirement. So I don't think expenses change very much, and that's where you start. So then you don't have to have a formula, you don't have to have a percentage of anything. You just have to ask yourself, what are my realistic expenses that I'm going to likely incur, and how do I make sure that that's where I start the planning with?
Gee, and you were just about to use that "I'm not a math whiz" excuse and try and dodge this one, weren't you? Not going to work. A little bit of homework goes an awfully long way in this one. Our guest this week is Portfolio Manager Adrian Mastracci from KCM Wealth Management. You're watching The Money and Wealth Show, and we'll be back.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our special guest this week is Portfolio Manager Adrian Mastracci from KCM Wealth Management. We're talking retirement and getting a game plan organized that allows you to retire successfully. Adrian, that's not going to be possible for a lot of Canadians. The Governor of the Bank of Canada keeps reminding us practically every week, for every dollar we make as a country, as a people, we owe $1.50. Debt is a big deal and a big negative in the lives of a lot of Canadians. So here we are in retirement season talking tax-free savings account, RSPs, to people, many of whom are struggling with serious amounts of debt. What's the advice from a professional? Do you bother with any of these retirement vehicles, or is game plan, action plan number one, get the heck out of debt?
Well, getting out of debt is always a good idea. It is risk-free. You control what you do, and you get to do exactly what it is that you want to do. So if you've got debt, by all means, put something away on it. If you've got a mortgage, as you probably know, you can make additional payments. You can make the annual payments. You can do a lot of stuff like that. If you have enough money for that plus an RRSP, maybe you can make an RRSP deposit and use the tax rebate that you get or the savings that you get and plow that against the mortgage or loans that you had. Start with the higher interest first, like the credit cards, the lines of credit, the mortgage.
The stuff that's hurting you the most.
Yes,
right.
The one that requires just a minimum payment. Never make a minimum payment.
Right.
Always make a much bigger payment than that. So I think if you do that, you will certainly be well on the way to getting rid of the monkey off your back, which is the debt.
I think the Governor of the Bank of Canada, Adrian, is being as persistent about warning us about debt because he is responsible for interest rates in this country and knows better than most of us they are not going to stay this low much longer. And an increase in interest rates is going to hurt a lot of us even more than people are already hurting just being in debt.
Well, that's right. We've all been lulled into the area of saying to ourselves, we can afford this at the rates we have now. But if we listen to Mr. Carney, then, and you say to yourself, maybe by mid-year, by the middle of this year, those rates will be going up somewhat. What will it do to my cash flow? Mm-hmm. Can I stand the fact that I'm now going from what I have today to something higher rate? Especially those that have a variable mortgage or a variable loan of some sort, prime plus, prime minus, whatever the case might be. Those that have a fixed mortgage for, let's say, another 3 or 4 years may not be affected as much. Well, as a matter of fact, they probably won't be affected.
Right.
But anybody with a variable mortgage should look at it and say, what do I have to do, if anything, to get to mid-year and do something about this rate that's probably coming down the road?
Back to our discussion about retirement vehicles, the tax-free savings account and the RSP, they differ dramatically in one other way. The tax-free savings account, as you've already told us, stays with you for life. You can let all that money that you put inside it grow tax-free and take it out at will. The RSP, on the other hand, is terminal. It ends when the holder of the plan turns, is it 71 or 72?
It ends in the year in which you turn 71, by the end of that year. So if this is the year that you turn 71, by the end of this year, December 31st, you have to do something with the RRSP that you had. You've got some choices. You can take all the money out and pay tax on it, which is something I don't recommend because that's a little harsh. You can usually take whatever's in the RRSP and parlay it into something else like a RIF. Most people will go with a RIF. So then you start at age 72 to withdraw a minimum amount that is legislated by the government. And at age 72, it starts at around 7.5% a year.
Of the total amount inside?
Of the total amount, yes.
Okay.
And I'm rounding those numbers a bit.
Now, is that taxable?
That is taxable just like it would be as if it was salary or income that you had before. So whatever comes out is fully taxable in your hands.
You talked about government entitlements a few minutes ago, and I just wanted to ask you about this because I seem to recall that if an individual in their retirement years enjoys a certain level of income, some of those government entitlements may in fact go away or get clawed back. Is that true?
That is true, and it usually applies to the old age security payments that you receive. If your net income for tax purposes is around $67,700 this year in 2011, then you start to pay back about 15% of your old age security payments that you received. And by the time you get to about 110,000, give or take a little bit, you will have paid all of your old age security back to the government. So yes, there is a clawback, but this is when you get to look at, let's say, if there's a spouse involved, you get to say, how can we massage our income so that perhaps my spouse takes on some of it, such as pension income that I can split with the spouse. Sometimes those spousal RRSP deposits in the spouse's name certainly will go a long way to reducing that clawback for OAS. So these are a number of things you can do to make sure that you get as best as you can from the monies that you receive.
But it's good to know, I think, and perhaps not everyone does, that these entitlements aren't just gold-plated and automatic. If you're beyond a certain threshold of income on an annual basis, some of those entitlements may go right back to Ottawa.
Well, that's right, they will, at least they can. And some of the other things you can do, for example, is take your CPP that you get and the one that your spouse gets, and you're going to actually split it between the two of you. So add both of them up, divide by 2, and that's what you get. And that may save you a few tax dollars, and it may give you a little more room to not send back that old age security back to the government.
We'll have a final word from our guest this week, Adrian Mastracci, in a moment.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Gold Ray Resources Corp. is developing a gold mine in China. Identified resource, 175,000 ounces of gold down dip to the south of an existing 1,500 ton per day operating mill. Resource remains open down dip into the east and west. Trading symbol GOR on the Venture Exchange. Website goldray.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
And now, with the final word on today's show, our special guest, Adrian Mastracci.
Well, Sterling, if our listeners do one thing these days is something like this. Get the money in the account. Get the cash in your RRSP account no later than March 1st. That way you get to deduct that amount that you put in for last year or this year as you see fit. And then take some time to go do some homework, figure out what kind of investment suits you, whether it's a stock or bond or something like that, and then go and do it, make the investment, and carry on. That will be a better way than just fretting about what it is that you have to do.
So it's just not necessary to have it all thought through by March 1st, is it?
It is not. Just take some time and just get the money in by March 1st. That's it.
Adrian Mastracci from KCM Wealth Management, thanks so much for coming by. Our thanks to Fritz and the crew here at Churchill's at the Holiday Inn in North Vancouver once again for the hospitality. For the Money and Wealth Show, I'm Sterling Fox. See you next time.
The Money and Wealth Show, brought to you this week by American Manganese Incorporated.